Let's start today's Business and Markets Week for the final week in January, looking at the Monetary Policy Committee decisions of the Central Bank on Friday. Good morning to our viewers here in Nigeria and around the world. I am Bosin Omofaye, reading 27.5% CRR hike. Investment Markets Community drilling down on the Monetary Policy Committee's decision of last Friday, raising the cash reserve ratio to 27.5% from 22.5% previous. Chapel Hill Denham wrote that that was a rabbit out of the hat against consensus status quo expectation. MPC took strong hawkish tilt, voting 9 to 11 members to raise CRR for the first time since March 2016. According to Chapel Hill Denham, the upside risk to inflation was cited by the MPC as a primary consideration, and noting also the build-up in the financial system, liquidity, and supply-side structural factors. CBN's decision was a tacit admission that the liquidity impact of the dovish balance sheet policy it embarked upon in the second half of last year is a major risk to external sector stability, the report from Chapel Denham says over the weekend. So on initial estimates, this is how it was broken down. The decision to raise the CRR will have effective impact on the banks from 29.3% in October 2019 to 34.3%. Additional 831 billion naira of banks' liquidity will be occasioned by the latest hike. And the rally at the debt market of fixed income, quote, will likely ground to a halt when market opens today. We'll check that out later within the hour. Meantime, banks are expected to sell down on positions to generate liquidity, and aversion will likely persist until February the 13th, when the bond maturity to ease banks' liquidity crunch happens. The impact, according to Chapel Hill Denham, is the cost of funds will decline by about 20% basis points on average in the full year 2020 estimate, against a previous estimate of 30 basis points. Coverage average NIM estimate down by 10 basis points. Full year 2020 earnings profit after tax by coverage banks for at Chapel Hill says will be lowered by 2.7% on average, implying a 7% year-on-year growth against a previous growth of a 10% forecast. Meantime, Chapel Hill says its banks' ratings remain unchanged, with top picks remaining Access, GT Bank, and Zenith. Meantime, Nova Merchant Bank also released its post-MPC report on Friday, economic research, saying 831 billion addition on higher CRR charge, adding to the existing system liquidity of 435 billion naira. Nova Merchant Bank weighs the MPC rationale for CRR increase and saying that will help the central bank to achieve two goals: reduce the cost of liquidity mop-up and combat possible currency speculation. So what's the tea leaves from Nova Merchant Bank on the CRR? Total open market operations maturing this year is about 9.83 trillion naira. Estimate cost of CBN mop-up will be about 521 billion naira. And if you add the CRR higher charge costs, that could cost that 521 to 487 billion naira. Meantime, liquidity ratio 65%, likely to impact the higher cash reserve ratio and further crunch in yields for the rest of 2020. Analysts are still poring over all of that, and the folks at AfriInvest, West Africa, are not an exception. And Ike Chioke is here this morning. There is the Group Managing Director and CEO of this investment bank and securities trading group. Good morning, Ike. It's good to have you.
Thank you. Happy New Year.
Great day. Let's get our toe in the water with the CRR hike to 27.5. What's your take at AfriInvest on this decision?
Well, I mean, I think this is coming from CBN being concerned about inflation. With the bifurcation of the OMO rules last year, you saw now that only banks and foreign investors can access the OMO market. You then see with the auctions coming in, CBN is essentially hiking CRR to prevent more liquidity hitting that market. We expect to see something like 4 trillion naira of OMO maturities in the first quarter alone. With this increase in CRR by 500 basis points, they're trying to at least neutralize 853 billion naira of that. So that's quite significant. And in that way, they can hold on to inflation, since they have decided in the trilemma of economics, exchange rate, inflation, and interest rate, they are going to leave exchange rate as it is for now. So they have to find monetary policy tools to manage the other two variables.
Were you surprised at this hawkish monetary position last Friday?
It was indeed a surprise. I think our view before that was that they would keep everything the same and maintain the consensus. But yes, we were quite surprised. But the action is not unexpected given all the other parameters they are looking at, and particularly inflation. Inflation has also been driven by the border closure, as you know, with food price inflation having jumped up quite significantly in the last 3 months of last year. So those are some of those variables that they must seek, that have guided them to take this kind of decision.
So where does this leave the pursuit of credit expansion via the LDR and a few other CRR arrangements which you had in 2019, somewhat from 2018, to encourage banks to lend? Now you have the CRR hike to 27.5, you have LDR at 65%. How does that crunch the banks in the middle here?
Well, I think the banks are being squeezed.
Squeezing
from both sides. You see, with increasing the LDR from, in fact, putting at a target of 60% before, we saw something like over 800 billion naira of potential capacity for banks to lend. When they didn't do that by September last year, CBN further increased it to 65%, and we were estimating something like another 1.5 trillion naira of lending capacity. Now, banks are therefore compelled to reach those thresholds. So clearly, the search for good quality risk assets is unrivaled. This has meant that banks are now reducing, lending rates astronomically. I've seen consumer lending is now in the mid-single double digits. Some banks are offering as little as 15% to borrow, whereas this time, 2 years ago, you couldn't borrow at less than 22% as an individual. So there's a scramble to create risk assets. At the same time, that is introducing more liquidity in the system. Now, together with the OMO maturities coming out, CBN is now worried that all that liquidity is going to now end up to create more inflation. So they then have to pull back on the CRR. And that's what you saw, that increase of 500 basis points.
This is getting a little bit interesting. So what does that leave the banking sector, Mike?
I think that all things being equal, we'd expect them to see positive momentum in their business this year. The government is already embarking on some kind of reforms. There's the early signs already with the tariff adjustment in the power sector, where if they allow the tariffs to stick, because they intend to enforce that from the 1st of April. If that begins to stick, then you can gradually see a power sector, a power industry that is more financeable. A lot of banks have lent money to many of the players, from the discos to the gencos, and they haven't seen any way out. If the tariff is more cost-reflective, then clearly, there's an opportunity to restructure those facilities, and that can further spur growth in the economy.
When you folks at AfriInvest release your report, you usually come up with very interesting titles. And this one is all about Nigeria in the new decade: nothing ventured, nothing gained.
Yeah.
Why?
Well, we took a snapshot of the last decade, the period from 2009 to, the period from 2010 to 2019. And we broke that into two sections, the first 5 years and the last 5 years. And if you just looked at two parameters, growth and inflation, we realized that in the first 5 years of the last decade, Nigeria grew at an average of 6%, while inflation was around 10 to 11%. However, in the second 5 years of the last decade, Nigeria grew at an average of 1.2%, while inflation itself had jumped to about 12 to 13%. Now, that's interesting. Now, within that period also, we saw there were quite a number of opportunities for Nigeria to reform and restructure, and in order to grow and, release cash. We recall, with a bit of nostalgia, the big strike action we all held January 2012 against the Jonathan government when they had wanted to remove the fuel subsidy. Now, we've estimated that if we had removed the fuel subsidy at that time, from 2012 to present, we would have released the equivalent of easily $5 billion every year into the Nigerian economy, which could have been used for capital expenditure. So you can imagine the lost opportunity. So that's partly why we call the report "Nothing Ventured, Nothing Gained." Now, as we look into the new decade from 2020 onwards, we are still faced at that kind of crossroad where we're still talking about the three big subsidies. There's the clear and present one, which we all know, the FX subsidy, where you have the differentiation between the CBN 305 and the NAFEX at 360. Then you obviously know the much talked about fuel subsidy, where we're burning easily 1.5 trillion naira every year. And then, of course, we talk about the power subsidy, amidst all the other inefficiencies in the Nigerian economy. So there's a huge opportunity to reform and realize cash that can be better utilized to grow and to grow the economy and create avenues for private sector to create jobs.
So in what areas, Ike, would you advise the current administration to venture into? Your report says nothing ventured, nothing gained. So what ventures, how do you think, should the fuel subsidy be removed? When, how? If that's one of it, should we revisit some privatization? Should we do more? Should we list the NNPC? Should we break it into some units to make it easily digestible, market-friendly? What more would you want to see?
I returned last week from the UK Africa Trade Summit. And one message that was very clear as you listened in the room was the UK, along with many other established countries, Western countries, are moving away from being carbon dependent. And here in Nigeria, we're still very much focused on oil. Meanwhile, the rest of the world is moving to renewables and sustainable energy and climate change and all those issues. Now, think about a country like Sweden, where they're likely to achieve almost 90% capacity to exist on just renewable power without any fossil fuel. Meanwhile, we're still focused on the oil economy. I think that we need to take serious advice that we can't continue to focus on the oil and gas industry. We need to take the advantage of today's current prices and reform that sector. Take the most we can get out of it, use the savings we're going to save in fuel subsidy, and use it to invest to grow. The idea of trying to use 2 trillion naira of our pension money to invest in capital expenditure is somewhat disingenuous because, the pensions are the individual savings of you and I. It's almost 10 trillion naira today. Now, think about it. In the pension fund industry, 70% of that money is already invested in federal government assets because the PFAs are buying government bonds and treasury bills and the same securities that we were just talking about earlier. So where are you going to take the 2 trillion naira from? Are you going to ask them to sell those bonds and hand it over to some other person? So I'm watching with interest because on one hand, here you are wasting money in areas like, fuel subsidy and power subsidy and the like. And then on the other hand, when you're doing a good thing, like having a fundable pension system, you want to go and destroy that. So the argument is that really, if you want to venture Nigeria, you need to really think of what to do with the big elephant in the room, which is the oil and gas industry.
Ike, are you hawkish or dovish on the economy? Are you, what's your expectation for exchange rate, inflation, and interest rates? Well, as you called it earlier, the trilemma that the administration and the monetary policy authorities face?
Well, the exchange rate I think the CBN will struggle to keep it stable. But as you see, there are some early warning signals. The current account deficit, where we are importing more than we're exporting. So that number has been in negative territory for the last 3 quarters. If that persists amidst this challenge in a situation where we have a treasury bill rates are now in the single-digit area, because you've asked the domestic investors not to participate in OMO, there's too much money chasing T-bills, and the yields have collapsed from around 15% this time last year to now about 6-7%. With people seeing that they're only going to earn about 6-7% domestically, they will start looking for other areas. And that could be to take their cash and try and buy foreign instruments. Now, that will put further pressure from the domestic sources on the same exchange rate, and importantly on our reserves. So we think it's still early, but by the second half of the year, CBN may want to look at new tools to make sure the exchange rate remains stable. But at the worst, we're looking at maybe it getting towards the 400, just under 400 region. In terms of inflation, already we've seen some warning signs from food price inflation. We expect that to go from around 11.9% as of December to perhaps around 12.9% towards the end of the year, unless there are some other changes in the fiscal policy area. Interest rate, again, that remains an interesting area. Given this...
When we say interest rate,
yeah.
what exactly do we say when we say interest rate? Is
Let's
it the benchmark rate or
well,
what rate?
The benchmark rate is really not relevant anymore. MPR is still at 13.5%, but look, all the yields have collapsed as a consequence of the amount of cash looking for yield. You understand? So you've always known that MPR has never really been a dictator to the way the Nigerian economy goes. It has never really affected the way banks lend to consumers. Now, because domestic, one-year rates have crashed, banks are already adjusting their lending rates. So we think that interest rate will remain the big area to monitor, because what CBN has done is helpful domestically. It's a great time to be an issuer. If you're a company and you want to issue in the bond market, it's an excellent time window to come, because you issue at much lower rates than previously. Lagos State is coming out with a 100 billion naira bond. I think price stock is in the range of now around 12-13%, which is great for them. Their last issue was, at 300-400 basis points above that. The equity market is also not left out. Market is already up 10.4% year to date this year. We've not finished January compared to 14.6% loss for 2019. Stocks like Dangote is up 19%. MTN is up over 20% year to date. So clearly, again, if you're an issuer, this is a time window to consider coming to the market, because this wall of cash that is around domestically is looking for opportunity, and something has got to be done with it.
Great. You're just touching on my very next question about where to invest in this new paradigm shift that we have on Market Street.
I think you need to, from if you have to look at it from both the fixed income side and the equity side. From the equity market perspective, I think that the banking stocks are going to be resilient due to the fact that they've always had good fundamentals, but the challenge of the Nigerian economy, which is kind of searching for growth, we've seen the overall economic growth for the year at 2.4%, is still anemic. While global growth is around 3.3%. So we're actually lower than the overall growth of the world economy. But nonetheless, banks are good fundamental stocks, particularly at the top tier level. I think that's one area to watch. Big stocks like Dangote, MTN, because of their size and the capacity, certainly something to have in the portfolio.
Is it a good time for money market funds?
Money market funds will be challenged because they're mostly investing in liquid instruments. They are buying T-bills, and then T-bills have crashed. But at least it's better than, even at 6%, it's better than putting in a savings account, which will pay you maximum a quarter of MPR, which is around 3%. So money market funds are still good for the average investor. For the institutional investor that used to earn 10, 11%, they need to be a bit more creative. So this is time to now consider funds that can do things like in the infrastructure space, in real estate, where you can have targeted returns that can touch 15%, maybe approaching 20% when you structure the
a very quick one. We have about a minute to go on the show.
Yes.
Are Nigeria's money bags, the millionaires and the billionaires, you manage funds for them. Are they worried about the current state of things in terms of MPR, interest rate, CRR? Are they worried? Are you getting phone calls?
Yeah, people are worried, but people are also taking advice as to what to do. I think the main issue is portfolio diversification. How much of your money do you have in fixed income versus equities? How much of your money do you have in domestic currency, Naira against other basket of currencies, and bearing in mind, that we are, as much as we think we are not, we are completely tied to the rest of the world. And as the U.S.-China trade tensions continue, all of those things will have impact on the domestic economy.
I was just worried if only those of us who are on the poor side are feeling this, if the rich are also thinking about how things are going on Market Street. Thank
Always
you.
a pleasure.
Thank you, Chioke. It's good to have you, the Group Managing Director and CEO at AfriInvest West Africa. That's investment bank and securities trading firm licensed and registered by the SEC. I'll take a break after this. 2 minutes, everyone. We'll be right back.